This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. The Wealth Roundup for the week of December 31st, 2025. I'm Terry Evans with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Well, I guess this is a look back at what was and maybe a look ahead to what we've got coming in 2026, a retrospective to a certain degree. But Patrick, it's time to look and see if there's any portfolio changes that are in store for us for 2026, right?
Yeah, in our kind of previous podcast, we were talking about what the economic environment should be like, or what we're expecting it to be like in 2026. So, is it going to be conducive to growth, or are we looking for perhaps a retraction in economic growth? And as we mentioned before, we're expecting positive GDP growth for North America, and largely for the rest of the world. We've talked a little bit about just the broad indexes. So the TSX, what our forecast would be for next year, and the S&P 500 for next year. But if we were to take kind of a deeper dive and look at the business level, I think that we can learn a lot about just what worked well in 2025, question whether or not it should continue to look positive in 2026, and then talk today about any changes that we might want to make.
Well, if I look back at the TSX composite for 2025, it basically was up 30%.
Yeah.
Is that overachieving? Is that something we can't expect that to happen every year, can we?
No, the long-term average rate of return on the TSX 60, if we look over the last, say, 50 years, would be sub 8%. So this is vast outperformance. In general, relative to the S&P 500, the TSX has lower performance. Again, if we look over a longer period of time. So if we look at the TSX and we look at the constituents of the TSX, is that the three largest market segments by market cap are financials, so largely the Canadian banks and life cos, industrials, and energy. Those would be the three biggest components. So something that certainly worked well in 2025 were the banks, and the banks had a fantastic year. Up over 30% if we look at the bank index for the year. So they lifted the TSX along with gold mining companies in Canada. They were primarily responsible for the outperformance of the TSX. The gold mining category was up over 100% for the year, just to kind of put that into context. I think if we want to kind of build some expectations about 2026, we have to look at those big categories. BMO Capital Markets, we don't cover our own stock, but if we look at RBC, TD, CIBC, Scotiabank, and National Bank, is that in general, our feeling is that the environment for 2026 is very constructive for these businesses again. We still have that upward sloping yield curve, which is very good for the margins, which we kind of talked about in our previous podcast, makes up about 50% of bank earnings. So that should continue into 2026. So we would still be positive and constructive on the Canadian banks. If we look at the industrials in Canada, is that the three biggest by market cap would be both of the big rail companies, CN and CP, and Thomson Reuters. Those three businesses make up about $210 billion worth of market cap. And when we think of our outlook, so again, BMO Capital Markets outlook is that we generally see all three of those businesses as relative outperform. But I think they do come with question marks. I think CN and CP, being the two preeminent freight companies in Canada, is they have been hurt by the new tariff program. So their valuations, their earnings forecast really depends on what kind of environment we're going to be in for trade and for cross-country shipments of freight. But I'm leaning towards being positive on those sectors. The third category is going to be energy. And in our last podcast, we talked about, what's happened in oil prices. So for 2025, oil prices, WTI, down 17%. Not a great underlying factor in terms of future performance with the commodity doing so poorly. So if we look at the three big businesses there, we're looking at TC Energy, Enbridge, and Canadian Natural Resources. I think energy is going to be the wild card for 2026. The TSX could have really strong performance again if we get a surprise upside on the energy front. If energy and world oil prices remain low, I would expect the performance, while it may still be positive in that category, I wouldn't be counting on strong performance. So we really need to see, I feel, a rebound in global energy prices. And we've talked in the previous podcast about just the cost of energy, getting it to market. There seems to be a disconnect. So I think that the numbers favor energy prices improving. Therefore, the outlook for the energy sector in Canada should be better.
In 2025, we saw gold go on a hell of a run. Is it a situation where we go, well, we missed the boat, or is it a situation where we just keep on buying in?
Yeah. So, I think all investors have to kind of ask themselves, why is gold doing so well? I think there's lots of different reasons. When we talked about in 2 podcasts ago, just what we kind of thought would be the biggest risks for 2026 and things to think about. Just, purchasing power of currency, purchasing power of the world's strongest currencies. If that purchasing power goes down because of inflation, or if that purchasing power goes down because the perceived value of, say, the US dollar, the Canadian dollar, the euro, or the British pound weakens, that's going to continue to support higher gold bullion prices. As we're taping this podcast today, is we're looking at a new record high for gold at well over $4,400 US an ounce. Traditionally, there's an inverse correlation between US dollar value and gold value. We're forecasting that the US dollar will depreciate slightly versus a basket of other world currencies into 2026. So I think that that's having a big impact on gold prices as we kind of finish off the year. But what I might suggest to some of our listeners is to look at that gold mining index and look at some of those large cap gold mining companies. Because if gold kind of fails to continue to set new highs, the gold price probably still remains relatively strong. So these gold mining companies are going to be very profitable in the near term because the underlying commodity is doing so well. So that, I think, would definitely be a consideration when we think about tweaking your investments as we go into 2026.
Tweaking, I think, is a key thing. It's like knee-jerk reactions is never ends up usually being a beneficial thing when it comes to investment. Isn't that right?
Yeah, and I think the place where the most tweaking is going to be required is our consideration for U.S. equities. U.S. equities, not just in 2025, but really going all the way back into 2019, they just performed so well. They've outperformed their long-term rates of return. Again, strong performance in 2025. And so I think if, as an investor, is that you find yourself today being overweight US equities relative to, say, Canadian equities, international equities, emerging markets, fixed income, and commodities, is that may be the place where some tweaking would be a really good idea. So if you're upwards of 40 or 50% in US equities relative to everything else, I think it would make sense to kind of take some of that money off the table and redistribute maybe 5 to 10% of it in places of your portfolio that have been underweight for some time. Just thinking about the US market, again, the same way we looked at the Canadian market, the biggest categories in the S&P 500 by market weight are, surprise, surprise, information technology, financials, and healthcare stocks. We've talked about Canadian financials, very constructive, is that we'd be the same with US financials. They're looking really at the same yield curve that we have here in Canada, lowering short-term rates, higher long-term rates, very conducive to profit making on US financials. When we look at healthcare, healthcare had a really tough 2025. It was really in the eye of the storm in terms of the Trump administration on the healthcare side. So healthcare is looking, very affordable relative to the rest of the index. Now, just because it's cheap doesn't necessarily mean that it's a great opportunity. Investors can often get caught in the value trap by going and looking at something that's cheap. But those really, those staple healthcare companies, perhaps a really good kind of entry point for healthcare. And then, with the information technology businesses, we've really kind of critiqued all the AI spending. We've talked about an AI bubble before. We have 10 US publicly traded companies that make up 40% of the index. I've never favored being overweight one or two of those information technology names. So I've always kind of preferred to own them as a larger basket. And so I think that would be a prudent portfolio change would be to look at that basket, especially if you look at the chip makers. Like last week, one of the things that caused the market to pause were Broadcom and Oracle. And these businesses are doing really, really well, but they came in with some financial data that the market assessed was maybe not good enough to support their high valuations, even though they're making gobs and gobs of money. That illustrates the concerns in around these businesses, and business by business execution is, will these businesses continue to be successful? Will they deliver on their earnings forecast going into 2026? If you as an investor aren't prepared to experience a big disappointment, if one of these companies can't improve on productivity, improve or deliver on earnings, monetize their investments in AI, then yes, you should reduce your exposure to that, and perhaps look at other ways to benefit by the AI spending spree. And one of those things might be on the energy front, is that we know that as the build out to AI continues, is it's going to take vast amounts of new reliable energy to be available to support all of the infrastructure that goes beyond or behind more AI applications. And so, looking at the big energy providers in North America, traditionally those are very conservative businesses. Those are utility-like type businesses. So, a business, not that this is a stock recommendation, but the big power management company, Eaton, has popped up in a lot of investment portfolios because of their ability to ensure, or in the business of providing reliable energy for large businesses and regions in the United States. And so I think that would be a consideration for perhaps making a tweak in an investment portfolio if you've made a lot of money on, say, something like an NVIDIA or an AMD.
So it's you're not jumping full force into the deep end, and you're not running away with your hair on fire. It's there's a
too late for that one, Terry.
All right, the Wealth Roundup for the wrap-up of 2025, December 31st, 2025, with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. And you can reach out to Patrick through his website, patrickmleonard.com. All of his contact information is there if you have any questions about the topics that we talk about on the Wealth Roundup, or if you'd like to contact him and find out how you can get your investment portfolio journey on the way. Happy New Year, Patrick.
Happy New Year to you and your family too, Terry.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.